Good afternoon, everyone, and welcome to the Stearns Financial Group online webinar about the Big Beautiful Bill and what it means for you. I'm Haleh Moddasser, and I'm joined today by my colleagues, Maxwell, Teresa Talton, and Dax Dixson. Our focus today is going to be on income tax impacts to you, our clients and taxpayers. However, we know that this bill came with a lot of controversy and just want to acknowledge that it is estimated that it will cost an additional $3 trillion of debt over the next 10 years. With that said, the pushback on that is that a stimulated economy with tariffs and the power of AI might mitigate some of that debt. So with that said, let's focus in now on the income tax impacts, the big picture. Tara, who is our financial planning manager, will be covering that for us.
Thank you, Haleh. And I'm going to start us off by looking at a very high level view of some of the key characteristics of the new bill. So I'm going to start with some items that are now permanent, and permanent means that they're not scheduled to sunset, which we've been talking a lot about as we've looked at the Tax Cuts and Jobs Act that has been in place for a while. So while we've been expecting under the prior law that a lot of the rules would end at the end of this year, now what we know to be certain under the new bill is that things are here to stay. So some of those key provisions are the tax rates that were lowered. Those are here to stay. The higher standard deduction is here to stay. And so in recent years, approximately 90% of taxpayers have been taking the standard deduction and not itemizing. And we expect that that will continue, but we will see a few more taxpayers, maybe 4 to 5% itemize under this new bill. We're also going to continue to have the increased child tax credits. We'll continue to see the qualified business income deduction, often referred to as QBI. And one big change is under the Qualified Opportunity Zone Fund incentives. Those are here to stay, but lots of the rules have changed. And as we go a little further in the presentation, Teresa and Dax will help us see the nuances of each of these things. But just thinking about the things that are now permanent, what we would expect if you've gone through our planning process as a client, a lot of your financial plans, when we looked at the income tax report, would indicate that in 2026, you would expect to see higher taxes. Now with the One Big Beautiful Bill, those tax rates are going to remain more stable to what you've seen over the last 8 years.
So Tara, I don't want to get everyone too excited, but I think what this means is that if you've had a plan done since 2017, so starting 2018 and on, that your plan potentially is going to look better, assuming everything else stays equal. Because in our prior plans, we had the tax rates going up in 2026, and now they won't. Is that right?
That is right, that the tax rates will go back to being more stabilized. So you will see a decrease in the taxes owed. It may not be as significant as you would like to see in that deduction. But also what we have to keep in mind in the back of our minds is part of this bill, there will be some changes to Medicare. And so some of these tax savings could be offset by potential higher healthcare costs.
Okay, so theoretically it should go down, but the devil's in the details, it sounds like.
Yes, always. Now we're going to shift to look at some of the provisions of the tax bill, the deductions that are temporary. So these deductions are only here for a limited time. Dax, if you'll put us on, there we go. So I'm going to start with, and when I say they're here for a limited time, I'm going to back up for a second. Some of the years that these are in effect are different. So Teresa will get us into those details, but that is something to pay attention to. So the big deduction, the SALT deduction, that's been in place. So it's not a new deduction. But what's changing here is currently you are limited to only deduct up to $10,000 of state and local income tax if you were itemizing. Now, under the One Big Beautiful Bill, you can deduct up to $40,000 of those state and local income taxes. But again, a very small percentage of people are itemizing now with the higher deductions. So it won't be as big of an impact across the board, just in specific situations. The remaining three deductions listed here on the screen, these are new deductions that have not been in place. So we're going to have a senior deduction for those who are 65 and older. We're going to have some deductions if you earn certain tip income and some deductions for some overtime pay. Also, we now have some car interest deduction that's allowed. So those are the new deductions. And again, they target very specific situations. So they may or may not apply to you.
Yeah, and so for example, tip income, and I hate to generalize, but most people who are servers, I would think, Tara, are not in a very high income tax bracket. So whether this actually helps those people or not remains to be seen, correct?
That is correct. They do expect that there will be a large percentage of people who earn your traditional tip income that they really won't see a tax benefit from this.
It sounds good though, doesn't it?
Yes, it does. And
And
same thing
then,
with the car interest. There's lots of rules around that, Holly. So a couple things that come to mind is it has to have its final manufacturing here in the United States. It also has to have it also has to be a new car and a new loan. So all those rules come into play and there's income limits.
so that could kind of trigger some car transactions, I would think, and maybe for domestic manufacturing.
It potentially could. There is an income limit on that too. So I wouldn't say that this is such a big benefit that you should rush out and buy a new car. But if you are considering a car purchase and do plan to take a loan on it, that would be something to take into account.
Excellent.
Okay. And then if we think about what's the bottom line for our clients, there's a lot of research out that estimates that the average taxpayer in 2025 will see a decrease in their tax liability of 2.9%. And the reason that it's lower in 25 and then jumps up in 26 to 5.4% is because we did expect that the law prior to the One Big Beautiful Bill was going to stay in place through the end of this year. So that 2.9% is mainly coming from the inflation adjustments on the deductions that we're allowed to have. Okay.
So it really kicks in 2026, you're saying.
It really does. I mean, while most of it is in effect for 2025, there are some things that are not in effect in 2025. We will see the majority in 26, but we kind of expected the Tax Cuts and Jobs Act to remain through the end of this year. So it's a smaller benefit. So, Holly, just for example, if I took someone who has around $250,000 of income and then they were taking the standard deduction, this would save in a tax liability, if we put it in dollars, a little less than $1,000. So that's kind of the impact that we're talking about when we're talking about this. It's not quite 2.9% in that situation, but that's roughly what the dollars are that are being saved. But then in 2026, you would save around $1,500.
Okay, big and beautiful. Thank you for that, Tara. Let's move on and get into a little bit more detail with our next participant, which is Teresa, who is Teresa Talton. Teresa is a financial advisor in the Chapel Hill office, and she's also a member of the financial planning team. I know many of you have had plans presented to you by Teresa. Teresa, can you get a little more granular for us here? Tell us what is permanent and what is temporary in these tax changes.
Yeah, thank you, Holly. So I'll cover the permanent ones first, which are the gift and estate tax exemption and the charitable deduction. So diving into the lifetime gift and estate tax exemption, that is something that allows a person to give money to beneficiaries either during their lifetime or at death, without having to pay the estate tax. So, and this is beneficial because the state tax rates and gift tax rates are 40%. So essentially it exempts a certain amount of money from that 40% taxation. And that number that is exempt has, or the amount that is exempt has increased over time. It doubled in 2018 from about 5 million up to 11 million. And right now it's sitting at about 14 million, but that was expected to sunset at the end of this year, which means that in 2026 we were slated to go back to a $7 million exemption. Now that this law has passed, it has become permanent. So the current 14 million per person will remain in effect and actually even increase by $1 million. So next year, the exemption will be 15 million per person. And what that means is that, a person, one individual can give 15 million during lifetime or at death or a combination thereof. And a couple can have essentially a $30 million estate without having to pay gift or estate tax on that and be able to pass that on to their beneficiaries and heirs.
So this is let's just clarify first that when you say permanent, it doesn't mean that it can never be changed, but it would take an act of Congress to change it, as
Exactly.
opposed to the way it was before, which it was automatically set to expire at the end of 26 and revert back, is right?
Exactly. Yeah,
Yeah, yeah.
exactly. And so what this is doing is limiting, I think, some of the complexity that people were considering or may have already implemented, assuming that rates were going to go back down to 7 million. So if that was something that was, if a couple or a person was going to have a 7 or a $14 million estate at their death, and they were thinking they needed to do some pretty complicated estate planning, that may alleviate some of the concern now with the higher exemption.
And this obviously impacts very few people have a married couples have more than $30 million in the population of our country. However, for those people that do, it's a massive savings because it's 40% literally above that amount is taxed at death. And so this, takes that limit higher. Just for reference, in the 90s, the number was 600,000. So it's been a gargantuan leap in the estate tax exclusion.
Yeah,
And here to stay for a while anyway.
yeah, until Congress decides to change it, yes. So the next thing that I'll review are the charitable deductions. So this is something that regardless of whether you itemize or take the standard deduction, there is a way for someone to deduct their contribution or their donation. The standard deduction, if you take the standard deduction, you can deduct 1,000 for a single filer or 2,000 for a married filers from the bottom, so below the line. And that's something that was in place back in 2020, 2021, and then that sunset, and they've brought it back. So this will begin in 2026. For those who itemize, there now is a hurdle that you have to get over before your entire donation is deductible. And so if, for those who know, the medical AGI floor of 7.5% is similar to that, except it's only 1/2 of 1%. So essentially what that means is someone who has $200,000 of income, 0.5% is their floor, which is $1,000. So if they gifted or donated $10,000, they would only really be able to deduct 9,000. So the 10,000 that they donated minus the $1,000 floor. So it reduces the amount of their donation that is actually deductible. Now, again, this goes into effect next year. So people who are charitably minded and who normally itemize or maybe want to switch to itemizing this year, they can consider bunching some donations together while they don't have that AGI floor this year.
Yeah, that's a good reminder that we have 1 year or the rest of this year to make that deduction, take that deduction before the floor kicks in. And the standard deduction, I know that as Tara mentioned, most people take the standard deduction now. And so one of the gripes that we heard from people was that they don't get a deduction anymore for their charitable donations because the standard deduction is so high. So I'm sure this was put into a place to kind of ameliorate that sentiment a little bit.
Yes, it was. And the other thing I'll add about that standard deduction donation, it has to be in cash. It can't be a donor advised fund or stock or household items. It has to be cash in order to deduct it on.
Cash to a charity directly. Yeah.
Exactly.
Okay, all good to know.
Switching over to the temporary tax changes. So Tara mentioned the SALT, the state and local tax changes a minute ago. Those go into effect actually this year, meaning that if you itemize, you can deduct up to $40,000 in state and local taxes, which really impacts those states with high property taxes like New Jersey, New York, California. And so that is going to sunset in 2029 and expected to go back to 10,000 in 2030. Who knows? There may be some push in Congress to continue this higher amount. And there is a phase out. It's a pretty high phase out. So you have to have AGI between 500 or more for it to actually phase out. And it fully phases out at 600,000 for single and married people. And then once it's phased out, it actually goes back to $10,000. It doesn't go to zero. So you still, if you're going to itemize, you could still get some deduction, even though you're a high earner.
That's good to know. Going back to the charitable deduction, we should have mentioned that it's still probably most tax advantageous if you're of age to have required minimum distributions or at least 70 years old to make a qualified charitable donation from your IRA because that's fully deductible, right?
Absolutely. Yeah. If you have to be over 73 now, or for those who were in the 70 and a half RMD age, sorry, you have to be over 70 and a half even today, even if you're not of RMD age. Correct
To
myself
be
there.
able to do that. And that's an above the line reduction as opposed to a below the line deduction, which is a big difference in terms of taxability.
Yeah, it's a dollar for dollar reduction by doing a QCD or a qualified charitable distribution.
Right. All right, the big one, which I think impacts most of our clients, is the senior deduction. I know everyone's eager to hear what this actually means.
So the original thinking, and a lot of what I've heard people say that they were hearing about, and I think there's some confusion out there, is the original idea was to eliminate the tax on Social Security benefits in total. That is not what happened. In the final bill, Social Security benefits are still taxable, and it's still under the same, is it 0% or 50% or 85% of your benefit is taxable, will depend upon your income. That is still in play. What they did to appease that idea of making them not taxable was to offer a $6,000 deduction per person for anyone over 65. So this is a nice addition to an existing over 65 deduction that we already have in place. And you do not have to itemize in order to receive this, but there is a phase out for married people, it's 150 to 250. So once you reach 250,000, you're fully phased out and you don't receive any of this deduction. But that's pretty high, and I think that's still going to apply. Most people will be able to take
Many people.
advantage of this.
Let's look at this graph that you've got because it really kind of showcases what is the overall deduction for someone 65 and over, assuming you're not phasing out.
Right, assuming you're not phasing out and assuming that you are taking the standard deduction. So I'll just review the single person, and then we'll look at the married filing joint on the far right. For a single person, deduction would be $15,750. So that was increased a little bit by about $1,000 under this bill. And then on top of that, if you are over 65 or blind today, currently, we already had a $2,000 deduction that was on top of the standard. And now on top of that, we have an additional temporary age 65 plus deduction. So a single person could have a total deduction, or a single person over 65 could have a total deduction of $23,750.
And this is set to automatically expire at the end of 28, is that right?
2028.
Yeah.
Yes,
So
2028.
the end of Trump's term, essentially.
Yes. Yes. I have
Okay.
a feeling this will be one that people will push for, though.
Yeah.
So we'll see. On the right, you can see the married filing joint. If both spouses are over 65, they get that double standard deduction of 31.5, more of the existing current deduction of 3,200, and then if they each get 6,000, that would be 12,000 for a total of 46,700. The only other thing I'll note is that you receive this regardless of whether or not you're taking Social Security benefits. So I think sometimes those two things are conflated, this deduction and Social Security benefits. But even if you're 65 and older, but maybe you've delayed your Social Security benefit, you're still eligible for this
So the
deduction.
deduction does not depend on you taking Social Security.
That's right. That's right.
Okay.
And the other thing I would like to add is that this lowers your taxable income. So you're below the line. It helps you on the below the line, below the AGI line. So therefore it lowers your taxes, but it really doesn't lower your AGI, which is what a lot of the tax provisions are based on. So your IRMA is based on AGI, which is your Part B, Medicare Part B or Part D surcharge that some people have to pay. Your Social Security benefits are based on how much of your Social Security benefits are taxable, is based on your AGI. Roth conversions account up in the AGI section. So this really doesn't help any of those. So just want to make sure that we separate those two things out in our mind.
Yeah, that's an important clarification. So thank you for that. Let's shift our attention now to the Opportunity Zone Fund. And for that, we're joined by Dax Dixson is a financial advisor in the Chapel Hill office, but he's also a member of the investment committee. And I know that Dax and I have helped some of our clients multiple times use the Opportunity Zone as a way to reduce capital gains tax. And so that's really how to employ these. So tell us what some of the changes are, Dax.
Thank you, Holly. But before diving into the changes, I think I wanted to revisit the 2017 Tax and Jobs Act, which was, provisions under Trump 1.0 for opportunity zone funds were within that legislation. And it originally established opportunity zones and by extension, the opportunity to invest in, opportunity zone funds. And so under that act, there was a formula that was created to determine different land tracts throughout the United States that qualified as opportunity zone funds. And the idea was to incentivize investment and, to encourage economic development in what would otherwise be maybe depressed areas of the country. What resulted actually from that was, there's some opportunity zones currently that, in Chapel Hill, for example, or Nashville, Tennessee, or Austin, Texas. And so based on the current formula that defines opportunity zone funds, a lot of those opportunity zones funds do invest directly in and around college towns. And so
It was a
fast forward,
little bit of a loophole, maybe let's call it, in
yep,
that the intent was to invest in depressed areas, but because of the criteria, it ended up that a lot of college towns qualified for that. So right on Franklin Street, you know, ended up being a building that was in an opportunity zone fund, which really was not the intent of the legislation. And I think that they've tried to correct for that this time, right?
right. So I think, back in 2018, 19, as we started seeing opportunity zone funds come onto our platform for investment, that's something that, us as an investment committee really reviewed it and determined, if this was a tool we could use for our clients to do some tax planning around maybe a bigger capital gain event. So fast forward to today, and the most recent legislation does make opportunity zones permanent within the tax legislation. However, there are some key changes to that we can review. But one of the big benefits is it makes it a rolling 5-year gain deferral. And after 5 years, you get the 10% step up in your original capital gain. So let's say if you invest 100,000 into an opportunity zone fund, 5 years from now, you'll have to pay capital gains on $90,000 of that. So, the previous provision was set to sunset in 2026. So no matter when you invested in in opportunity zone funds prior to this bill being passed, um, your taxes would come due on your 2026 taxes. So I think we're in a bit of a lame duck period right now, Holly, because if you do invest in an opportunity zone fund now, you get very little deferral benefit because maybe a year and a half or so when those taxes that come due on your 2027 return or 2026 return, which you file in April of 2027. And there's no step up in basis. And so that benefit went away in 2019. So this does reinstate that benefit and makes it a rolling period instead of just everything expires in 2026, which is good. They continue. Good.
I'm sorry. So what we're saying, Dax, is during this period, now we don't want the economic tax tail to wag the economic dog, right? So if you have the opportunity to sell a business or you want to reduce risk in your portfolio and there's a lot of gains there, I mean, you should absolutely do those things if the time is right to do those things. However, if you can wait till what, June, let's say, of 2026, you have 180 days to invest in an opportunity zone fund, which would get you to January of 27. And then you get a 5-year deferral on the tax that's due. And then you also have to pay tax on 90% of that gain, as opposed to 100% of the gain, correct?
Right. Right. And I think that's an important point is that the new legislation doesn't go into effect until January 2027. And so basically you have to get that 180-day window into January 2027 to kind of be able to defer those gains within an opportunity zone fund. But I think you're spot on here. If you need to de-risk, like if you're heading in retirement or potentially you have a big purchase on the horizon and you need to raise cash from the portfolio, or if
You
you
have a business to sell
yeah,
and
if
the
you have
wrong
an
buyer
opportunity to
comes.
sell a business, yeah,
Yeah.
absolutely. You don't want to let an economic opportunity go by just to gain a tax benefit. But to the extent that you can delay into maybe the latter half of 2026, you could potentially have the option of using an opportunity zone fund to defer some gain.
And
Um,
Dax, let's talk for a second about the shifting census or
mhm.
the different metrics that they're now using to qualify for an opportunity zone fund. How does that impact the risk of this investment versus the tax benefit?
Yeah, I think it's a great question, and I think we're going to have to do more research on that side as the new census tracts come out. Currently, based on where they're at, we saw good investment opportunities through some of our fund managers to invest in different projects within opportunity zone funds and get that tax benefit. Now you're going to have stricter income requirements and a stricter poverty test for opportunity zone funds. And so I think there's more to be determined on that side. We'll have to do due diligence on funds as they come available, kind of late 26 into early 27, to make sure that the forward-looking risk return profile is still attractive for investment within the opportunity zones.
And I know a
Um,
lot of this depends on the fund manager. So when this legislation first came out in 2017, everybody and their brother tried to take advantage of it. And we had a lot of fly-by-night opportunity zone funds, many of which went under. And, we will continue to vet, but we do need to keep in mind that the criteria has changed. So as you say, Dax, we'll look at the risk reward in the right opportunity with the right manager. It's a tremendous benefit, but the
yeah,
timing has to be right and it has to be a good fund.
yeah, because I think one of the big, or probably the biggest benefit is the capital gain forgiveness provision. So let's say, if you put just to use round numbers, that 100,000 into an opportunity zone fund and it doubles to 200,000 over 10 years, that extra 100,000 in capital gain comes back to you completely tax free. And so that's never taxed. And so to the extent that, you can invest and have that growth, the opportunity is great and you have the tax benefits that stack on top of that return. But to your point, if we do our due diligence and the risk return isn't the same or isn't compelling, you don't get the benefit of a gain if you don't have one, right? And so I think that's the most important thing to consider. You know, if you get that gain, the tax benefits kind of are very beneficial.
Yeah,
So,
and we've got other ways as well to reduce taxes. We have tax loss harvesting strategies.
sure.
These
Yeah.
are algorithmically generated losses. They're not economic losses. They generate tax losses. And then we've also got 1031 exchange funds. So you can put, let's say, non-productive farmland. If you sell it, suddenly you can
Sure.
have income from that in those. So there are other tools that we've got in the toolkit. But I know this is can be kind of confusing. So let's look at your chart that you have so that we can make sure everyone understands all the benefits.
Yeah. So this is, and I'll use this timeline to kind of talk through some of those strategies you were talking about, Holly, because if you at a high level, opportunity zones have a triple benefit. First is you defer that gain for 5 years under the new tax legislation. The second is that you reduce your gain by 10% when you have to pay taxes after 5 years. And the third is finally, as I mentioned, any gain within the Opportunity Zone Fund is eliminated after 10 plus years in the fund. So, in year one, let's say it's 27, we go in with a capital gain for a client, as long as the due diligence proves out that there's still good investment opportunities within Opportunity Zones. Um, we defer the gain in year one, and then we can pair it with something like tax loss harvesting over that 5 year window to maybe reduce further some of those gains that you may have come due in year five. And so you can carry forward those losses into year five and further reduce what you may have to pay. So it does buy us a little time to do some of that tax loss harvesting you were talking about, Holly.
Yeah, and those capital losses are can be carried forward in time. They don't expire, so they can continue to stack. You can view it as a tax asset.
Correct. Yep. So I think it's important. I think when we were discussing this, Holly, we talked a lot about incentives. And so the incentives for the tax bill, as far as opportunities on funds, are to encourage, um, you know, investment into to economically depressed areas. And to the extent that you also get a tax benefit for doing so, as long as the investment makes sense, I think it can continue to be a good tax planning tool for us.
Yeah, completely agree. And I know we've had lots of clients who've benefited enjoyed the fruits of their investment as well. So thank you. I think that wraps up everything that we've got on just our summary, but I want to encourage all of our viewers to, you know, please contact your CPA. It was a general overview. It literally is one size fits one. Much of this, as you saw, phases out, depends on your tax status, your marital status, so on and so forth. So this is just a general issue spotting exercise for you. And if you have any questions and need to talk to us, don't hesitate to give us a call. Thank you.